What's up, everybody? Hope you're having a great day. Chuck Fulkerson, TradersArmy.com. I've had a lot of people recently asking me, where's the big picture trend going in the market, right? A lot of people that are not traders, they're investors, right? They've got long-term investments, or maybe they're not investors at all. They just have a 401k and they want to know, is it safe? Is it something that I'm okay with? And so I thought I would take a few minutes today and just look at the big picture market perspective. Where do we think the big picture markets can go from a technical basis? And I'm only going to look at technicals here and really give you some big picture analysis and some big picture views. So I'm going to start with a chart of the S&P 500. And what you can see here on this chart of the S&P 500 is this is a weekly chart. For those of you that are not familiar, that means that each one of these red and green bars represents 1 week's worth of price action. And a red candle means that prices went down for that given week. A green candle means prices went up for that given week. And so if I go back and take a look at the most recent week we have, we can see that last week was maybe the biggest red candle since the initial fall that we had from COVID back in early of 2020. So it was a very large expanded range candle is what we would call that. It was a very big down week. Now, the thing that I pay attention to are what are called swing highs and swing lows. And when I look at swing lows and swing highs, think of it like this: swing low, swing high, swing low, swing high, right? And then a swing low, and then we have another swing high and a little swing low. So we're looking at little swings in the market back and forth. And what you'll notice if you look at that is that as we've continued to go up, the market has respected every swing high, meaning every time it comes back to a prior swing high, it has hit that prior swing high and then it bounces off of it almost like a rubber band and then continues to go higher. A prior swing high, we come back to it, we keep going higher. A prior swing high, we actually didn't come back to this one. We'll come back to that a bit later. A little bit of a swing high, we come back to it. And then we add this swing high right here, we come back to it. But notice we've now, for the first time since the COVID market crash, have broken below a prior swing high. So that's something that is very interesting, that we broke below a prior swing high. And so the next swing high that has not yet been touched would be somewhere down in here or even lower, about 4,000 in the S&P. Now let me clear this out. Let me clear off all these drawings. The other thing to consider is when I look at those swing highs and swing lows, the one that makes the most sense to me, where we have not yet retouched it, but we certainly had a period of equilibrium or stability, was right in here. This was a nice little area where we kind of went along sideways for a period of time, but have not yet come back into that region or that area. And so when I look at that, I think that's probably the most obvious area or level for the markets to find some decent support and some decent pullback opportunity. Now, how far is that from where we were at the high? From where we were at the high, the high being 48.18, a pullback to that region would be about a 20% correction, right? A 20% market correction is not an unheard of market correction. If we think back to the COVID fall was 34.68%, right around 35%. And so a 20% market pullback would certainly not be unheard of. And I think that's actually a really fair estimate for where the price can go. Now, if we go back a little bit further in time and we go back just 10 years in time, show 10 years on the charts, we had a 20% market correction right through here. This was actually a 20% market correction that we had back in 2018 before the 2020 COVID drop. And then we had another market correction that was about 15% back in 2015. So 20% market corrections are certainly not unheard of. They do create strong buying opportunities for people that are willing to get back in. Now, I'm not saying that this is going to be one of those, but it would be a pretty strong drop. It's going to be a very big drop from a lot of people's perspective. and it could be a good spot to re-engage the markets. Now, there's one more thing that I take a look at, and it is what are called moving averages. And a moving average simply is a line that shows the average closing price of a security over the last X number of periods. And so I use the 8 and 20 moving averages. Now, the 8 is what's called an exponential moving average. The 20 is what's called a simple moving average. So the 20 period moving average is the green line. The 8 period moving average is the blue line. And let me give you the simplest system ever for investing. And really what you're looking at is you're out of the market. Out. You're not long. You are in cash or moving to a defensive situation when the market closes below the 20 period moving average. And you can see here that we've closed below the 20 period moving average as of last week. When do I re-enter? Well, you re-enter when we come back up above the 8 period exponential moving average. So as of now, to me, this is the sign where I think it makes sense to just sit on the sidelines a little bit, allow the markets to come back down. When's the last time that we saw this happen? Well, the last time that we truly saw the market crash below the 20 was during the COVID drop. We came very far below the 20 period moving average, and then we came back up above the 8 a few weeks later. Now, when's the next time that we crossed below the 20 period moving average? Well, we closed below it for one brief week in October of that year, and then rallied right back up above it the very next week. We and then we hadn't touched the 20 period moving average since then. Not closing below it. The key is closing below it. We hadn't closed below the 20 period moving average since then. And so allowing you to really allow to ride those bigger runs. You can see as we go back in time that 20 period moving average, when you catch a good bullish run, will hold for a very long time. And so that's what I'm looking at right now, is that we've closed below the 20 period moving average, thus telling me that I'm going to be a little bit more cautious and maybe be willing to go a bit more bearish in my sentiment for the medium term. So hopefully that makes sense to everybody. Obviously, if you have questions, please send us an email, support@tradersarmy.com. This is more for the investing mindset, but it's not just about day trading or swing trading. It's also about what are the wealth essentials. One of the programs that we have in our on-demand content is a wealth essentials session where we cover how do I trade long-term investing utilizing options to protect and grow my long-term wealth. If you have any questions, give us a heads up. Talk to you soon. See ya.